Something quiet just happened in the crypto market, and almost nobody is talking about it the right way. This week, Bitcoin and Ethereum ETFs pulled in more than $1 billion, their strongest week since April. It sounds like good news, a bullish headline, another green candle for the crowd to cheer about. But here's what almost every article missed. One single company took roughly 80% of that money. Not 80% of the attention, 80% of the actual cash. So the real question isn't whether $1 billion came back into crypto this week. The real question is why nearly all of it walked through one single door. And if you stay with me until around minute 17, I'm going to show you a number so much bigger than 1 billion that it will completely change how you think about this story. Quick note before we go further, nothing in this video is financial advice. I'm not telling you to buy anything, sell anything, or trust any company blindly. What I am going to do is walk you through the data, connect a few dots most people are skipping over, and let you draw your own conclusions. This is a breakdown, not a prediction. Morning, afternoon, or night for you right now, drop it in the comments. I always like knowing where in the world this channel actually reaches. And let's start with what actually happened, because the numbers matter here. Over the week ending August 7th, spot Bitcoin ETFs in the United States pulled in roughly $853 million. Every single trading day of that week closed positive. No red days, no hesitation. Spot Ethereum ETFs added their own piece on top of that, bringing the combined total for both assets to just over $1.1 billion. That's the strongest combined week for crypto ETFs since April of this year. For context, this rebound didn't come out of nowhere. July was actually the worst month for Bitcoin ETF flows in all of 2026. The first half of the year saw more than $5 billion in net outflows from these products. The first negative half year since spot Bitcoin ETFs launched back in January of 2024. So August didn't just continue a trend. August reversed one. But don't celebrate the $1 billion yet, because the number itself isn't actually the most interesting part of this story. Here's where things get uncomfortable. Of that $853 million flowing into Bitcoin ETFs, BlackRock's iShares Bitcoin Trust, the fund known as IBIT, absorbed somewhere between $690 and $700 million of it on its own. That's not a large slice. That's most of the pie. On the Ethereum side, the pattern repeats almost exactly. BlackRock's Ethe fund pulled in roughly $200 million out of a total category inflow of around $245 million. Add it together, and BlackRock's two funds, IBIT and Ethe combined, captured close to $900 million of the entire $1.1 billion week. That puts BlackRock's share at somewhere around 80% of all new institutional crypto money that entered the market this week. Now here's the part nobody's paying attention to. This isn't a one-week accident. IBIT's cumulative net inflows since launch are now approaching $61 billion. No competing Bitcoin ETF, not Fidelity's, not Grayscale's, not ARK's, comes remotely close to that figure. So the question isn't whether BlackRock is winning. It clearly is. The question is why the gap keeps widening instead of closing. To understand why this matters, you have to stop thinking about BlackRock as just another company that happens to sell a Bitcoin product. BlackRock manages trillions of dollars across pension funds, wealth management platforms, retirement accounts, and institutional portfolios. It already has relationships with the exact investors who are the most cautious about crypto. The compliance departments, the risk committees, the advisors who need a regulated familiar wrapper before they'll touch a digital asset at all. When a financial advisor at a major firm wants exposure to Bitcoin for a client, they're not opening a crypto exchange account. They're clicking buy on a ticker symbol inside a brokerage account they already use every day. That's the advantage. Not better technology, better distribution. And this is where the story gets a little uncomfortable for anyone assuming Bitcoin's next wave of demand comes primarily from retail traders watching charts at midnight. Because the biggest future buyers may not be anywhere near a crypto exchange at all. Are you positioned for that shift, or are you still watching it happen from the sidelines? Let me know, honestly, in the comments. Let's frame this properly, because this is the structural shift underneath the headline. For most of Bitcoin's history, the path to owning it looked like this. An investor opens an account on an exchange, transfers funds, buys Bitcoin directly, and either holds it on the exchange or moves it into a private wallet. That path works, but it involves friction. Private keys, self-custody responsibility, operational risk that a traditional institution simply is not built to handle. The institutional model looks completely different. An investor allocates through their existing brokerage or retirement account, buys shares of an ETF, and gets price exposure to Bitcoin without ever touching the underlying asset directly. No private keys, no exchange account, no self-custody. Just a ticker symbol sitting next to their stocks and bonds. Once Bitcoin becomes a line item in a portfolio instead of a separate technological experiment, the size of the potential buyer base changes dramatically. You're no longer competing for the attention of crypto enthusiasts. You're competing for a tiny slice of every diversified portfolio on the planet. And that's exactly why this matters right now. Here's where we zoom out, because $1 billion sounds massive until you place it next to the actual size of global capital markets. Global pension assets, sovereign wealth funds, insurance portfolios, and private wealth management accounts collectively sit on a pool of capital measured in the hundreds of trillions of dollars. I want to be extremely clear about something before I go further. What I'm about to walk through is a hypothetical scenario, not a forecast. Nobody knows what percentage of that capital will ever touch Bitcoin. This is simple math meant to show you the scale of what's possible, not a prediction of what will happen. Imagine, purely as an exercise, a global capital pool of $100 trillion. A 1% allocation into Bitcoin from that pool would represent $1 trillion in new demand. A far smaller allocation, say 1/10 of 1%, would still represent $100 billion. Suddenly, a $1 billion week doesn't look enormous anymore. It looks like a rounding error compared to what a tiny shift in institutional behavior could eventually produce. This is where smart money is already positioning, quietly, one weekly inflow report at a time. I don't want to make this exclusively a Bitcoin story because Ethereum's ETF flows are telling their own version of this same narrative. This past week, Ethereum ETFs actually opened in negative territory. Monday saw net outflows of around $11 million. Then something shifted. Tuesday brought in roughly $54 million. Wednesday added $61 million. Thursday jumped to $92 million. Friday closed with another $50 million added. That's a full reversal inside a single week. And once again, BlackRock's ETF fund led nearly every single day of that recovery. Bitcoin tends to get framed as digital gold, a store of value play for institutions looking for an inflation hedge or portfolio diversifier. Ethereum plays a different role. It underpins tokenization, stablecoins, decentralized finance infrastructure, and increasingly, the technical backbone that traditional financial institutions are quietly experimenting with. If Bitcoin represents the monetary thesis, Ethereum represents the infrastructure thesis. Institutions may eventually treat these as two entirely separate allocations rather than one interchangeable crypto bet. And this could be the part of the story that Bitcoin-focused investors aren't paying enough attention to. So why would BlackRock want to dominate this category so aggressively? I want to be careful here. I'm not claiming there's a secret memo sitting in a BlackRock boardroom outlining a hidden master plan. We don't need one. The strategic logic is sitting right out in the open. First, distribution. BlackRock already has these products sitting inside portfolios managed by thousands of financial advisors across the country. Second, brand trust. Institutional allocators already know the name. There's no education gap to overcome the way a smaller, newer issuer would face. Third, scale. Managing trillions of dollars gives BlackRock infrastructure that smaller competitors simply cannot replicate quickly. Fourth, product ecosystem. Bitcoin and Ethereum exposure can now sit right alongside traditional equity and bond products inside the same platform, the same statements, the same client conversations. Fifth, the tokenization thesis. BlackRock's leadership has spoken publicly about tokenized assets becoming a meaningful part of the future financial system. And crypto ETFs are effectively the entry point into that broader thesis. None of this requires a conspiracy. It just requires understanding what a company that size actually wants, which is durable market share in a category that's still being defined. Here's the pivot that I think matters most in this entire story. Maybe the real competition isn't over who owns the most Bitcoin. Maybe it's over who controls the gateway through which traditional capital reaches Bitcoin in the first place. There's a meaningful difference between owning an asset and owning the on-ramp that leads investors to that asset. Every ETF issuer in this space is competing for the same things: assets under management, liquidity depth, institutional relationships, fee revenue, market share, and investor mind share, meaning which ticker symbol an advisor reaches for by default when a client asks about crypto exposure. When billions of dollars keep flowing through one dominant gateway week after week, a network effect starts to form. Liquidity attracts more liquidity. Familiarity breeds more familiarity. Advisors default to the product with the deepest volume and the longest track record because it's the safest recommendation to make. And if that pattern continues to compound, the concentration we're seeing right now in a single weekly report could become a permanent structural feature of how institutional capital accesses crypto going forward. If this is starting to make sense because we're about to connect it to something bigger. Let's walk through the mechanics of what I'd call the institutional adoption loop. More inflows lead to more assets under management. More assets under management increase the fund's relevance and liquidity. Greater relevance increases institutional visibility. Increased visibility leads more advisors and allocators to consider the product for client portfolios. More consideration potentially drives more inflows, and the cycle repeats. This is exactly the kind of compounding advantage that turns an early leader into a near-permanent one, the same dynamic that's played out in index funds and brokerage platforms and in payment networks over the past few decades. But there's another side to this story, a side that could completely reverse the bullish framing we've been building for the past 12 minutes. Here's where things start to break down, and honestly, this is the part I think deserves more attention than the celebratory headlines are giving it. ETF inflows are not permanent capital. They can reverse just as quickly as they arrived. We just watched this happen in real time. July was the worst month of the year for Bitcoin ETF flows, following a first half of 2026 that saw more than $5 billion in net outflows. A single billion-dollar week does not erase that. It's a rebound, not a guarantee. Macro conditions matter enormously here. Interest rate expectations, broader risk appetite across markets, and Bitcoin's own volatility can all shift investor behavior within days. Large institutional allocators can rebalance portfolios quickly when conditions change, and unlike long-term retail holders, they often have far less emotional attachment to holding through drawdowns. $1 billion entering this week does not mean $1 billion is permanently locked into crypto going forward. So the real question becomes, what would actually make these inflows sustainable rather than another short-lived rebound? Do you think the system can hold this pace, or are we watching another temporary bounce before the next reversal? I want to hear your honest take in the comments. If you want to track whether this story is temporary or structural, here are 3 signals worth watching going forward. Signal number 1 is flow consistency. A single strong week is interesting. Several consecutive weeks of sustained inflows are far more meaningful because that starts to look like a genuine shift in institutional behavior rather than a short covering bounce or a reaction to one news event. Signal number 2 is BlackRock's continued share of the total. If that concentration around 80% keeps holding steady or grows even further, this stops being a temporary story and starts becoming a structural one about market concentration in the entire crypto ETF category. Signal number 3 is the broader allocation shift. Watch for language changing across the financial industry, from treating Bitcoin as an alternative, speculative asset, toward treating it as a standard piece of a diversified portfolio, the same way gold or emerging market equities are treated today. If that third signal starts appearing more clearly, this $1 billion week we're discussing today could eventually look like the opening scene of a much longer story, not the main event itself. Now, here's what I told you I'd come back to. Earlier, I mentioned a hypothetical $100 trillion capital pool. Let's revisit that idea, still purely as a scenario, not a prediction. A tiny allocation, say 0.1% of that hypothetical pool, would represent roughly $100 billion. A slightly larger allocation of 0.5% would represent $500 billion. And a full 1% allocation would represent a full $1 trillion in new demand. These are not forecasts. They're scenario calculations meant to illustrate how asymmetric the capital base really is compared to what's currently flowing into these products. This is exactly why the ETF infrastructure matters so much. It gives traditional capital a familiar, regulated mechanism for making that kind of allocation decision without requiring institutions to build entirely new operational capabilities from scratch. So let's bring this all the way back to the title of this video. Maybe BlackRock's big plan isn't some secretive price target or hidden accumulation strategy. Maybe it's much simpler than that. Become the dominant, trusted bridge between the world's traditional capital and the emerging digital asset economy before anyone else builds that bridge at comparable scale. Follow the chain we've walked through today. A $1 billion weekly inflow, concentrated institutional demand, BlackRock capturing roughly 80% of it, built on ETF infrastructure that removes the friction traditional investors face, creating direct portfolio access for capital that was previously locked out of this asset class entirely. Sitting on top of a capital pool that dwarfs anything crypto has seen so far. That's the full picture most headlines missed this week. The most important number in this story today probably isn't $1 billion. It might not even be 80%. The number that actually matters is the percentage of the world's traditional capital that eventually decides Bitcoin and Ethereum deserve a permanent place in a diversified portfolio. If that percentage stays tiny, this entire institutional story still has an enormous runway ahead of it. But if that allocation starts becoming normal, ordinary, expected, then this week's billion-dollar inflow could eventually be remembered very differently, not as a peak. As the starting point, what would you actually do if this plays out the way the data is starting to suggest? Are you positioned, or are you just watching from the outside? Share this with someone who needs to see where institutional money is actually moving before it becomes obvious to everyone else. And if you want the next breakdown on where capital is rotating next, subscribe to the Wealth Continuum, because this is exactly the kind of shift we track before it becomes mainstream news. If you've been watching for a while and this finally made the picture click, do me a favor and drop the word gateway in the comments. I'm tracking which topics to go deeper on next, and that'll be my signal. I'll see you in the next one.